Welcome to Freed on Business. He grew up in South Florida, has been in business here since the early 90s, and has closed over $3 billion in deals. He's seen it all. He always has an opinion, and he's always ready to share it. Informed, entertaining, and connected, he has his finger on the pulse of South Florida's business community. He's Jim Freed, and this is Freed on Business.
All right, everybody, welcome to another edition of Freed on Business. We're going to have a focus on residential mortgage lending. First of all, I want to start out by thanking our sponsors for over a decade, the folks at Warren Henry. Of course, Larry and Eric and Warren, I saw them all out at Supercar Saturday the other day. What a tremendous time we had. It's a great venue, and they're a great family to do business with. So remember, thanks again to our sponsors for over a decade, Warren Henry. And now we're going to talk about residential mortgage lending with my good friend and my mentor in that sector. Let's see, where's Ed Cairo? Ed, is he out there?
I'm here. How you doing?
There he is.
Hi.
High five, Ed. High five. Great to see you, Eddie. Now let's talk about why it's important. First of all, I had to go get a special license to be a residential mortgage broker, the NMLS license. So only a certain number of people are able to do this. Is that correct?
That's correct. Absolutely. Yep.
And your firm is licensed too, right?
We are licensed mortgage brokers in Lake Worth Beach, Florida is our headquarters.
Well, you're licensed across the state and you're located in Lake Worth, right?
Correct.
Okay. Now, one of the things I want to talk about was brought up to my attention earlier today because my mom's the president of her condo board, and she told me that they were having a lot of problems because everybody in her condo sells the home by getting Fannie or Freddie financing, and that they just got their approval for that pulled, which meant that a lot of people were having a problem selling their condos. Now, let's talk about why that might be pulled, Ed, and then talk about the solution that you have.
Well, there's a lot of guidelines for condo financing, and typically for lenders, there's a little more risk in condo financing than it would be in single-family homes historically. So they have a lot of different rules that need to be followed. One of which is they need to have 10% reserves for everything they collect. So whatever money they collect, reserves has to be 10%. And if it doesn't fit Fannie or Freddie. Investor concentration, only so many investors can be in there. If there's litigation, that would be an issue. I mean, there's various issues as to why that would happen.
How about like an open repair permit, like their roof had a problem, or this 40-year certification showed that they need repairs that aren't funded yet. Is that also an issue?
That's also an issue, yeah. When that comes up, that absolutely is an issue.
So, me being a primarily commercial guy, really didn't know much about this until my mom called me. It seems like this is a bigger problem every day.
Yes, and it falls into the category that we call non-warrantable condos, where that's a whole different type of financing. With Fannie and Freddie, FHA doesn't do too many condos anyway, but Fannie and Freddie wouldn't do it because of certain reasons, whatever it might be. Could be anything.
Now, do you have bank lenders that would do this kind of mortgage?
We do, and again, we have to know the specifics, obviously, of what's really going on. But on a general sense, we do. We have banks that'll do non-warrantable condos. One way that we are able to finance a lot of these condos is if it's a primary residence and they put down 25%, then we can waive the questionnaire, and that's where they find out all that information. So as long as the insurance is in place, there's no litigation or anything like that, we can then tend to get them done that way. If it's an investment property or a second home, they have to put 30% down. Same thing, we waive the questionnaire.
So when you waive the questionnaire, that's okay, right?
Mm-hmm. Oh yeah, it's very okay. I mean, there's probably 40 or 50 questions on there. They get pretty deep into it. As far as the lenders are concerned, our lenders, as long as they put enough money down, they got enough equity in the property that they don't issue the questionnaire.
Now, what kind of lenders are we talking about? Are we talking about private lenders? Are we talking about banks? What kind of lenders are we talking about?
We're talking about banks. Banks will do that. If it gets to a little bit more sticky, then you're getting into some closer to private lenders, I would say. And private lenders have trouble with condos because of the risk. So it's a tough situation when it comes to condominiums, depending on what's wrong with it, what the issue is.
but you have lenders. What kind of a term? What kind of a rate premium? What kind of, how would a loan look from one of these folks? Is it kind of standard to the general consumer? It's to a bank. It's a bank, right? Usually not a private lender.
Right. It's definitely a bank, and depending on what is the issue. Again, let's say they don't have enough reserves, or there's too many investors in there, or whatever. If they put the 25% down, the rate's going to be almost what it is if it was perfect. Maybe the difference of a quarter or a half to the rate, possibly. So it's really not that bad. If it gets into other things, I mean, the rates could obviously go up depending on what the issue is, what the risk is.
And today, this is, what kind of rates are you typically seeing? Are rates kind of trending down? Are they kind of going up? Are they following the increases with treasuries? Tell me a little bit about what the rates are that you're seeing in this sector.
They've been pretty much following the 10-year is what we've been looking at. They dipped a little bit. They actually increased the last couple of days. I haven't looked today yet. They usually come out around noontime. But the rates have been on a good, clean borrower. You're looking at probably the low sixes, mid sixes, which, isn't too bad. If they have lower credit scores, it might be closer to 7, so that's kind of where it sits, between 6 and 7%, I would say.
But that's down from, just a few months ago, is it not?
Yeah, to a certain extent it is. Yeah. I mean, and it jumps, Jim. So, on a daily basis, it changes, many basis points per day. So it's kind of hard to predict, but I would say it's down a little bit from what it was, but it's still, you're still in the sixes, mid sixes, high sixes probably.
And do they charge their rate as a spread off of an index, or how does that work?
That's a good question. A lot of it is, to a certain extent, it has to do with the Fannie Mae rate, but lenders, what they'll typically do is they can have add-ons to what those numbers are. And also per state, it's different. Every state has different numbers. So it could be as simple as the lender, doesn't, did too many loans, doesn't have any money left, and they raise the rates a little bit and they don't want it, or something to that effect. Or they're a little more aggressive and they lower their rates, they want to do more volume. I mean, that plays into it also. So it's kind of hard to say, but that's about where it is.
Now, what size loans are we talking about here in South Florida? Dade, Broward, Palm Beach County, some of the other big counties in the state of Florida, Hillsborough, Orange. Does it vary by county?
What vary by county?
The loan amounts, the maximum loan amounts, the loan sizes.
Yeah, in the Miami market, there are typically a lot of jumbo loans down there. Where you start to get into the Palm Beach and Broward market. They're getting very close to, those numbers also, but they typically tend to be a little bit less. I mean, the loan amounts in Broward and Palm Beach that we see are probably anywhere from 300 to 600 or 700, I would say, right in that range. For a typical family, I mean, obviously there's people buying big homes, but, that's pretty much what they're looking at.
So regular condo, you can get a person one of these bank loans in a you could non-warrantable, or one of these condos that has a little hickey or an issue. You can get them 300,000, 400,000, 600,000. And that's with 20% down. So we're talking about 30% down. So we're 25. Talking about $1 million loans, $1 million price tags.
Yeah. Price tags. Yes. Yeah. 25% down on a primary, 30% down on a second home investment. Yes.
And you've been closing these loans?
Oh yeah. I've been closing them for years. Sure.
And how does it look right now? Have you seen an uptick in this kind of loan?
A little bit. I mean, there's certainly what I always try to encourage the client, if they can, to do something like that if possible, because it just makes it a lot cleaner and easier for them. If the condominium goes if they had sales prior and they're approved, that's one thing. But in some cases they're not sure, or they haven't done it in a while, or they lost their approval. Now we can get them reapproved. That happens too. But, in most cases, I try to encourage them to try to put the money down to make it just a little simpler for them.
And do you need an appraisal to do this kind of loan?
Yes. Yes.
How long does that usually take?
An appraisal will take, I would say, typically a week or so by the time we order it. They go out to invest, take a look at the property, inspect the property, come back, rewrite it, and send it back to us. There are times, though, you have to understand that if the file is strong enough and the guy's got good credit and income and assets and so on, we get appraisal waivers, which are real nice. And
Really?
yeah, the only way we'll know that is when we run it through Fannie or Freddie. And if Fannie and Freddie algorithm likes that particular property or that building or whatever it might be, and there's enough positive sides to the loan, we'll get what they call an appraisal waiver. So we don't have to have an appraisal, and that saves the customer, $500-600 also.
So what if it's a non-warrantable condo? Do you still run it through that Fannie and Freddie?
No. If it's non-warrantable and we can't go with what we're talking about, that's a whole different type of loan. And yeah, they'll definitely require an appraisal.
Now, can you get a non-warranted condo loan for more than 75%?
I'm going to say 75 is probably the number, maybe 80, depending on the situation, but no less than that. We could probably go 80, depending on the customer and depending on what the actual issue is. Because again, every issue is different, and they're going to evaluate each one. So, we have to really kind of zero in on the condo itself and figure out what's going on there.
So, do regular banks? You walk into your bank, are they doing this kind of loan?
No, you're not going to see a bank do this type of loan.
Well, but you're telling me that you have bank lenders that'll do this. What kind of banks do you have? Maybe they don't have a street depository or street office or something.
Right. These are mortgage banks. Exactly right. They don't have street depositories, and they're designed to do these type of loans. Where typical, Bank of America or whatever, Wells, I think, is out now. Chase and them. I mean, they just won't do these.
Does mom and pop or the realtor have access to these mortgage bankers, or do they need like an NMLS license, or how does that work?
They don't have access to them. No, they would have to go through either a mortgage broker or some sort of a lender, correspondent lender or somebody like us. We have, 30 or 40 different sources to work with that. And what we typically do is we try to figure out exactly what's going on. And once we do, then we're going to match the bank with the issue, to try to get the person the best deal they possibly can.
And tell me a little bit about your firm. You work with your brothers. How long have you been in business? That kind of stuff.
Been in business 25 years. Work with my two brothers. My younger brother, Greg, is a MBA, and he was brought in to straighten out the two dinosaurs, my brother and I, the two older ones. And so he does typically the internal workings of the operation. Myself, what I'll do typically is, our loan officers will bring in loans, and I'll help them coordinate, figure out what to do with it, how to structure it properly, all that kind of stuff, get it into the lender. And then my older brother, Paul, is our closer, and he'll typically go through the whole closing process. Once it's clear to close, we're finished, he'll go through the numbers with the customers and make sure that the buyers and sellers and everybody understands exactly what's going on. If there's something needs to be fixed, we do it on the spot so they don't go to the closing and have issues then. So that's what we do typically, the three of us. And we're known as the Mortgage Brothers. And, we have a nice enjoyment working together, the three of us.
Now, you've got these non-mortgable condo loans. You've got other loans that you do. Do people need to have 1099s? Can you do, a lot of people do make money here in South Florida in cash, and then they buy, a condo, one of these, $300,000, $400,000, $500,000 condos. They got the 20% down, but it's a non-mortgable condo. Can you do them without a W-2?
We can typically now. We break it down into, number one is if somebody, let's say somebody is an investor and they want to buy a condo and they want to rent it out, or they want to buy whatever it might be, a single family home or whatever. We have a loan that will basically work off the cash flow. So there's no income, no job verification. As long as the market rent, we'll send an appraiser out there with a 1007 rent schedule on it to give us an idea what the actual rents are for that particular property. But as long as the rent is more than the principal and interest payment, then they get approved. I need a 660, depending on the lender. Some go down to 620 credit scores. We can go to 80% on those. And those tend to be really good loans because you get these investors that typically, have the house they're living in, but they may want to buy multiple properties. So in this fashion, it's a good way to do it. We can do up to 10 properties that way. The only part of that is they have to have what they call reserves. So you'd have to have a couple of payments put away in the bank to make sure the lender feels comfortable that you can make the payments if in the event there's any sort of, vacancy or whatever the case may be. Some are 6 months, some are 12 months, depending on the deal.
Now, what if somebody wants to live in it as their primary residence? Do they need a W-2 to do these non-warranted condo loans?
In most cases, yes. When it comes to primary residence, it's a little bit different. Although I do have a way to do a no income, no asset verification. No income, no job verification for primary residences. We can go up to 75% on that. And the answer would be yes on a non-warrantable. Again, depending on the condo, because not every condo could be financed. If they're in heavy litigation or whatever, then nobody's going to touch it.
Okay. So to put it all together and put a bow on it for the segment, you can do one of these non-warrantable condos, which the definition of non-warrantable again is what? Is
for first ease of the argument here, if it wouldn't pass that condo questionnaire, well, there's 50 questions and there's certain things that they wouldn't be able to do. Could be reserves, could be investor, could be all kinds of reasons. That we call non-warrantable. But it's really something that's not Fannie and Freddie approved. That's really a shorthand. Really what it is. Yep. And you can do those loans. You're seeing them, the $300,000, $400,000, $500,000 range, which means you're able to finance property that's probably a purchase price of like $1 million. Yes, absolutely. And rates are just a little bit higher, and points are just a little bit higher than they would be for an owner-occupied, fully conforming loan or a loan that's Fannie and Freddie, insurable. Yep. Yep. Everything is based on risk. So the more layers of risk, the more either points or interest rate that might be. However, if you think about it as a cash flow situation, you decide whether, this is something that works for you, because if you can't get a loan with Fannie and Freddie, then you have to look at something alternatively. And then you have to decide whether that's something that fits, your needs. And it could be a short-term solution. Some of those loans, the investor loans, come with prepayment penalties and all that. So those would have to be worked out. You can either buy out the prepayment penalty, leave it, it really depends. Some of them you have to stay in for 2 or 3 years for it to make sense. But again, that's a cash flow situation. You say, okay, it costs me X amount a month more to do this as opposed to that, but I have the asset, I secured the asset. 3 years from now, I'll worry about it as long as I can afford to pay for it. If it makes sense and it's positive, then you do it. And for primary residence, are these 30-year fixed rate loans? Are they adjustable every 3 years? How's that look? For primary residences, for fixed rate, there's adjustables out there, the 5 and 7 year adjustables, the 10-year adjustables. There's not a huge appetite for it. Part of the reason is that they're not priced very well compared to a 30-year fixed. Part of the reason is the lenders know that the rates are a little higher now, and people are not going to keep these loans forever. So, they know that they'll get into a loan like that and it'll get refinanced in a heartbeat. So, what they'll do typically is they, you'll find when they get priced nowadays that there's a little bit of discount where you have to pay the lender a little bit to get the money sometimes. And part of that is just them making their profit because they know they're only going to be in it for a period of time. Once the rates go down, everybody's going to refinance these things. They're in usually for the long term, but not in this case. Okay, well, listen, we're going to take a quick break right now, and then we're going to talk about HELOCs, the home equity loans. Mm-hmm. And I assume that's something that a lot of people are doing to keep their first mortgage on, but get a little bit more money out of the house to get some flexibility. We'll be right back with Ed Cairo, president of American Home Finance. Mr. Mendoza, it's your turn.
Oh, look at him playing the thing with the coffee. You know I like that coffee. Hey, everybody, you know what else I like? I like my friends at Warren Henry. I was up there at Supercar Saturday, found out the place to get the good coffee there at Supercar Saturday. This time was the Haagen-Dazs store. It was great. I loved it. I can't tell you exactly what I had because my wife would kill me. But when you're looking to buy or lease a car, I want to say, hey, it was great to see Warren out there, Larry, the whole Warren Henry team. Really enjoyed meeting them all and seeing them all. What great people they are. It's great to be part of the Warren Henry family. And remember, when you're looking to buy or lease a car, you want to get every advantage that you can. That's why you have to check out Warren Henry, Land Rover, Range Rover, Infiniti, Jaguar, and now Lincoln. The whole Lincoln team was up there this time. So great to meet all the folks from Lincoln. I really enjoyed meeting them there too. I sat in the brand new Lincolns they had up there. Boy, one of them is as big as a bus. I mean, it's gorgeous. Those are up at 151st and Biscayne, up in Gainesville. They've got their Audi store down in the Keys. They've got their store that sells all the great nameplates. What do all these cars have in common? Well, they're all great cars, and they come with the Warren Henry Advantage. It's a long list of services that Warren and his team have put together, Larry and the team have put together. It includes, of course, the free service loaner car. Thanks, as always, to my personal service provider, Maytal Stark. She treats us like gold. You get the polishing up. If you scratch your rims, they'll give you your keys. If you lose your keys, they'll guarantee you're getting a great value on your used car that you're turning in. They'll make sure you're guaranteed the best price on your lease or new purchase. They'll give you 3 days to make sure you love your car. Guess what? You will, because it's a great car. You can turn it in if you don't like it. And remember, join me, my beautiful wife, Vivian, my mom, lots and lots and lots of my friends and clients. We're all members of the Warren Henry family. You should be too. Always the best price, always the best service, always Warren Henry. And hey, everybody, it's Jim Freed here. I'm the founder of Sandstone Realty Advisors. Our team is here. We've got, more than 50, 60 years of experience on our team. We've worked for big life insurance companies, all the boutique mortgage brokers and mortgage bankers who ran one of the big real estate companies, international real estate companies down here for years. And we have clients from all over the world. We're doing all kinds of creative financing right now in the commercial end, watching our show, and you'll hear all about that. And our clients come from all over the world: Brazil, Australia, New Zealand, Europe, Canada, international, domestic. We work with real estate operating companies. We work with high net worth investors, family offices, all the product types: apartment, land, hotel, office, retail, all of them, multifamily, condo, apartment. So with the capital market shifting, it becomes more and more important to have somebody who's been there and done that. See, I've got the red hair, the white hair to prove that. My mom has the red hair. I have the white hair. Been through the movie, been through the ups, been through the downs, seen it all. Give me a call. And remember, I self-actualize by helping other people achieve their dreams and goals. I do that by solving their problems and giving them peace of mind. And whenever you call me, it's always all about you.
Welcome back to Freed on Business. Connect with us on LinkedIn, YouTube, Facebook, and Twitter at Jim Freed or at Freed on Business, and on Instagram at Jim Freed1. Now, back to your host, Jim Freed.
All right, this week's theme is residential real estate lending. We're on with my good friend, Ed Cairo. He's the president and founder of America Home Finance. Up in Palm Beach County. He and his brothers are the Mortgage Brothers. Where is Ed? You always dawdle, Mr. Mendoza. There he is.
Hello.
Hi, Eddie. Eddie holds my NMLS license. Eddie is a licensed mortgage broker. His company is a licensed mortgage brokerage company. And we're here to talk about the missing link from when rates were really low, but the really popular person now, the HELOC. Eddie, what's a HELOC? What does that stand for? What does that all mean?
It's basically a line of credit on your piece of property, and HELOCs are becoming very popular now, of course, because, people have their 3% rates or 4% rates and they don't want to refinance. But Typically, people need money for certain things, or there's all kinds of reasons why somebody would have to refinance or want to obtain money. So people are getting these HELOCs, which is basically a second mortgage, you might say, behind the one you have on the mortgage now, on the house now.
Now, Ed, rates are what people would consider to be historically high. An old man like me knows they're still historically low. I got out of college, they were in the mid-teens, closing up in on 20. That was during the Jimmy Carter administration. Now you know how old I am. But still, even with a HELOC, and what's like a rate on a HELOC compared to like a first mortgage?
Typically, you'll see probably in the 9% range, I would say, like an interest only, maybe 10% right in there. You know, it's going to be a little bit higher than the first. And you're right. I mean, the rates in the sixes historically are actually good. You know, people got a little used to the 3% numbers, which were a little bit, lower than most times. But, 6% is actually a good thing. And I think when people start to get a little more comfortable, their mind changes. But if you have a rate at 3% on your house or 4%, you do not want to refinance it into 6 or 7. So what you'll do is you'll take out an equity line, which gives you access to money out of your equity of the property.
Yeah, but I think that one of the really important things to realize as the Fed continues to increase interest rates is that a lot of people's credit cards and other installment credit devices are linked to that. So
Yes.
Their rate may be 17, 18, 20, 22, 23, 24%.
Right.
And there's still been an incredible pressure of people buying items. And I got to believe that they're using HELOCs to pay off those credit cards and lower their overall cost of capital in their portfolio. Thoughts?
Absolutely. And, that's one of the tools that we use for a lot of people, because obviously we have sit down with people and we take a look at their financial picture. And that's part of what we do, obviously, to get them to a point where they're cash flowing properly and so on. And an equity line is a very important tool for us because, you're right. I mean, with all the things that have gone up from eggs to milk to gas to who knows what, people are still, making the same kind of money they did before. So the credit card numbers are over, they say, about $1 trillion now, which is the highest it's ever been. So to try to alleviate some of those payments, we can take out an equity line, a line of credit on their house. And the nice thing this time of year, I mean, right now, is that the rates, the values of the properties are really not going down. And I would say based to, with the amount of people moving into the area and so on and so forth. So the equity is staying pretty solid. So if we can tap some of that equity and maybe pay off some of those credit cards at 22%, even if it's at 10%, they tend to cash flow better. But more than that, what I try to do with when I explain this to people is, take the money you were spending before and let's start banging down those credit cards, because you have a lot more cash flow going on right now. So utilize that money to get that debt down, because the key is getting that debt down right now. That's important.
So for people that aren't perfect, and that's, I guess, every one of us.
All of us, right?
You also, let's say, what type of credit score is as low as you can finance right now?
For an equity line?
Equity line, first mortgage, because my real point is that no matter what if they're close, you can also help them improve their credit. So I want to kind of talk about that topic a little. Tell me a little bit how that works.
We can. So Fannie and Freddie 620 credit score is pretty much the lower part of the credit, right? Now, if we did an FHA loan, they say it goes down to 500 credit score, but try to get one of those done. They're tough, but 580 is probably the cutoff, somewhere in there. And can you do it? Yeah, the rate's a little bit higher. The debt to income ratio is a little bit lower. They get a little more conservative because obviously there's history there. But what it's for is really to try to get people from point A to point B if we can, but not put them in a position where they just can't afford the payment. That's the reason why the debt to income ratio is a little bit less on some of those loans. But if they come into us and we find that they have, let's say, a lower credit score, a lot of times it's part of it is either late payments or that a lot of their credit cards are maxed out. And when the credit cards get maxed out, that's when the scores start to dip. So we are able to kind of work with people to either manipulate, what money they have on which card, which can give them a couple of points possibly, or we could do a rescore where we can have them pay off a few things if they have the money, and we can rescore it that way, and we can raise their credit. There's a lot of things that we can do, but typically 620 is the number you're looking for.
And you know, does somebody have to have a W-2 income to do loans with you? Can they get a regular bank loan if they have don't have a W-2? You know, I know a lot of people in real estate and they get paid on commission.
Yeah, right. True. Yeah, we typically, if somebody doesn't have, let's say, a W-2 or any of that, there's loans that we can do where we take their bank statements, their last 12 months bank statements, and add it up. If it's a primary, if it's their personal bank statement, we can use the income as it comes in, and whatever the deposits are, we'll go through them and make sure that they're not a car sale or anything like that, but I mean actual deposits from whatever they're doing, and we can utilize that for income. If we use the business, usually there's like a 50% expense factor. So if they have a restaurant and they're depositing $20,000 a month, I mean, typically we can give them $10,000 a month for income personally, and they can go ahead and buy a house that way with 20% down. That's
and
one
are you starting to see. I cut you off, Eddie. What did you say?
That's one of the ways. I mean, there's 1099 loans. There's a whole different source of loans like this, but in that flavor, that's what we can do. Yeah.
And are the rates higher on that? The points higher on that? How does that work?
Yeah, the rates are higher. Again, more risk to the lender. So typically you'd say the rates would probably be maybe a point or two higher. You might pay 1 or 2 points to get it. But again, if there are people that need to have homes and families and all that, so we just figure out with them if that's something that they can do. And they don't have to be long-term loans either. You can get them in the house as long as they can pay comfortably the amount. And then at some point we refinance them and get them into something better when they're showing more income.
And how much are the down payments that these loans typically require?
Typically 20%, 20, 25, depending on part of it has to do with the credit score of the customer and also the property and so on. But right between, I'd say 20 to 25% is typical.
Can you get, I always get these calls from people, they want 80 or 90% mortgages. That's only on a purely terrific Fannie and Freddie type of person, right?
Yeah. Because when you get into, past the 20% down, now you deal with mortgage insurance and all that kind of stuff. So now it starts to change a little bit, and that's Fannie and Freddie.
I've got a number of friends that we've been working with who've got, family that's getting a little older. They live in their home for a long time. They've got what I would call a lot of equity locked up in that home. And a lot of times they want to know about a reverse mortgage. It's been a real dirty word. It's been a real difficult thing for people to get their hands around. I'd like to hang around one more segment because I want to talk about the reverse mortgage market and do a little myth busting here. You got a couple more minutes for me?
Absolutely. Of course.
All right. Mr. Mendoza, do your magic. I want to thank Ed Cairo for helping me out on the residential mortgage overview show that we're doing today. A lot of folks are needing those residential mortgages and they're not sure how to get them or do them or what they can do. And I really appreciate Ed being my mentor in that space. A person who's really been a mentor to me in a lot of different ways is Warren Henry. Warren Henry Zinn, the person that owns Warren Henry Automotive. He and Eric Day, the brilliant guy he has working with him, are really helping Larry Zinn propel that firm to new heights. And Larry is just a phenom. I've watched Larry grow since he was the F&I guy when I bought a car, well over a decade ago from them at this point. We've been members of the Warren Henry family for over 25, 30 years now. I remember my wife bought a Volvo from Warren Henry, Warren himself, a long, long time ago. They've always treated us like family. They're going to treat you like family. And so remember, when you're looking to buy or lease a car, you want to get every advantage that you can. That's why you have to check out Warren Henry, Land Rover, Range Rover, Infiniti, Jaguar, and now Lincoln up at 151st and Biscayne. Met a lot of the new Lincoln folks. Got myself a Lincoln hat, put it away in my hat drawer, so I should have worn it today. Shame on me. But they've got that Lincoln store up on 151st and Biscayne as well. Up in Gainesville, they sell Audis. Down in the Keys, they sell all their great nameplates down in the Keys. And what all those cars have in common is that they're all great cars, and they all come with the Warren Henry advantage. You go, Jim, what's the Warren Henry advantage? Well, if you watch the podcast by now, you know what that is. It's a long list of services that you get when you buy your vehicle or lease your vehicle from Warren Henry. Of course, it includes you get their service department. If you do service with them, they will give you the free loaner. Thank you, as always, to Maytel Stark for making sure I get that free loaner and get the great family service for myself and my mom and my wife. We love it over there. She treats us like gold. They'll polish up your rims. I always park my car real close to the curb and scratch it up. They polish up your rims. I've lost my keys more than once. They help replace those keys. They're not cheap. They're those computer chip keys. They will guarantee you're getting a great value when you trade in your car. They'll guarantee you the best price on your leased car or your new car. They'll give you 3 days to trade in your car if you don't like it. Nobody really does that because they're tremendous cars that people love. So remember to join me, my mom, my beautiful wife, Vivian, lots and lots of my friends. We're all members of the Warren Henry family. You should be too. Always the best price, always the best service, always Warren Henry. I love those videos. They always show projects that I've worked on. I do a lot of the high-rise residential and office here in South Florida as both a finance broker, investment sales broker, and mortgage and business consultant. I'm Jim Freed. I'm the founder of Sandstone Realty Advisors. Been in the business for probably 35 plus years. That's what all the gray hair is all about. I've been through many, many real estate cycles. We're starting to come to a cycle that's going to be characterized by many things, including what people are calling the rate and term default, which means that they're going to not be able to borrow as much as they did the last time. They're going to have to come up with new equity sources. We've got that with private lenders, family offices, mezz and pref equity. My recommendation, get more equity in your deal through either pref equity or a private investor. A new partner, don't really go get it with debt. That could just get you into more trouble down the road. That's my freebie advice for the week. We work with investors and real estate operating companies from all across the globe. We work with family offices from all over the country, all over the state, and again, all over the globe. We have clients from Australia, New Zealand, Brazil, Latin America. I guess Brazil is in Latin America, but a big part of Latin America, Canada, Europe, all across the globe, the Middle East. So remember, my personal brand is that I self-actualize by helping other people achieve their dreams and goals. I do that by solving their problems and bringing them peace of mind. And so remember, the one thing, if you DM me or call me, the numbers and letters are there on the screen. And if you know me, you can just pick up the phone and do it. Whenever you call me, it's always all about you.
Welcome back to Freed on Business. Connect with us on LinkedIn, YouTube, Facebook, and Twitter at Jim Freed or at Freed on Business, and on Instagram at Jim Freed1. Now, back to your host, Jim Freed.
Well, we're on with my good friend Ed Cairo. We've been talking about condo building loans and when the building doesn't qualify for Fannie and Freddie loans, how to liquefy from that. Hey, Mr. Mendoza, that's your cue. Come on. There he is. When you can't get a loan, I know my mom's the president of her condo association. A lot of unit sales have been falling through because the people all need financing. The unit sales there are in the $200,000 to $400,000 range. Pretty much that whole price range relies on the government market. Mr. Cairo over here has been telling us how he's got banks and lenders that'll help you. That if you're not Fannie and Freddie, he can help you with that. Then we talked about HELOCs, which are basically second mortgages to help you pull equity out of your home and reduce your overall portfolio cost of capital if you got a whole bunch of credit cards. And now we're going to talk about something that's really interesting. I know it's a lot of my friends have been calling me and talking about that because my friends are, they're getting up there like I am. but their parents are locked in equity and have an incredible amount of equity, especially after this big run up in the homes. And parents want to age in place. When you move your parent, it really isn't good for you. It isn't good for the parent. They lose their synagogue or church. They lose their favorite grocer. They lose their doctor. They lose their orientation. And so, Ed, I know that you're working with my family, I'll admit it, my family, to help us with reverse mortgage. And I originally resisted it. I've resisted it for a couple of years now because I thought that it was really an equity scrape and it was a scheme. But that whole industry has been overhauled with the aging baby boomers, and it's now much more user-friendly and borrower-friendly, and it's really harder for anybody to really get in trouble. So tell me a little bit about reverse mortgages, how much somebody can borrow, if it's, what the structure is, stuff like that, fees, go at it. You're the man. Tell me what we got here.
Okay. So typically, you alluded to it before. I mean, there are people that are retiring and they've got a ton of equity in their property. And when they're retiring and, let's say you have Social Security and some pension and whatever the case may be, you've got a payment coming in. And the payment is going to be a substantial amount as compared to what's coming in some cases. So what we can do is we do a reverse mortgage on the property. And what does that mean? They have to be 62 years of age or above. And depending on the age, there's actually a scale, but they'll lend typically 65% or so of the value. So if you have a mortgage in place, that'll get paid off. And then the rest of it is dealt with at that point. But what happens is, the nice thing about a reverse mortgage is for the older person is there's no payment for them at all, right? They have to pay their taxes and their insurance, but as far as the principal and interest portion of it, they don't pay it. So they then, and really what happens in most cases is they'll take out, they can take, there's a couple of different ways they can do it, but most people take out like a line of credit, very similar to an equity line. So the first year they'll give them half of it. They won't give them the whole thing. They'll give them half of whatever they're, supposed to get. So the house is worth $500,000, let's say 65%. Let's say as an example, they get $300,000 to use. That's
60%, Ed.
Ah, thank you. See, right off the top of my head, it was close. So let's say that's the case. So what they'll do is, they'll give $150,000 the first year for them to use as like a line of credit. They can pay their taxes, they can pay their insurance, they can pay anything they want. They want to go on a trip or whatever it is.
Do they have to take the whole 150,000, or can they just take like
No.
25 or 30 and draw it down over time? So and do they charge interest on the whole thing, or just what they pull out?
Just what they pull out. Just what they
high five.
Yeah. So they can take out, right. So they don't have to take out the whole thing. And then what happens is the way it gets paid back is no different than, let's say, a forward loan, because there's a payment and there's interest associated, but it's coming out of the equity of the property. That's what's happening. So when it's all said and done, the people themselves get a chance to utilize the equity in the house for themselves, the older couple, you might say, and the only ones that have to deal with it is the children later on when it's all said and done, because they've now utilized their equity in their property, and the payment for the lender, they're subtracting from the equity as they go. So eventually that's whatever's left. Like, they can't take the house, like the old myth of, you get one of these things and they take your house away. That's not the case at all. If they pass away or whatever's left is what's in the estate at that point.
Okay. And so it's not really a high leverage loan. So that keeps it safe. What are the fees associated with this?
Fees are a little steep. It's basically done by FHA. So there's an upfront mortgage insurance hit, which is expensive. Depending on the size of the loan, it could be 10 grand or anywhere in there, 8 to 10 or 12,000. So that's one of the hits. And then it's not, let's put it this way, it's not a cheap loan by any means. I mean, it's definitely a little expensive. But on the other hand, the people don't have a payment, which is huge for people. My mom, as an example, is on Social Security. She doesn't have one because she didn't have a mortgage in her house. But if she did, I would easily put her into that, because the Social Security money that she's getting, she would be able to use 100% of it, plus have access to the equity in her property. So that's kind of, where the positive part lies. And as far as the fees, I mean, it's a little bit higher than, let's say, a forward mortgage, but nothing that they couldn't handle.
And what's the interest rate? If I'm getting residential first mortgages for pretty good people in the 6.5% to 7% range, what will be the differential for this interest rate?
You're pretty much around the same. It's right around the same area. Yep. On a variable basis, it's not locked. I mean, it's a line of credit, so it's variable. If it goes down, it goes down. If it goes up a little bit, it goes up a little bit.
What are some, I think I recall you saying that there needed to be some special training for people that took out this loan, a little education. What are some of the special requirements for the borrower here?
So that's a really important point, Jim, because what happens is when and the U.S. government set this up to protect the older generation, right, from predators and things that unscrupulous people. So what'll happen is that we'll initiate the deal and we'll send the deal to the bank and all. And what'll happen is we'll get them some numbers, and there's an advocate that they have to sign up for that'll go through all the numbers and explain the whole thing to them based on our numbers. So there'll be a third party person that literally takes the estimate that we sent them, and they'll go through each number and explain it to them, make sure they understand it, everything to do with the loan itself. And then they, once they go through that, that's like a qualification. They have to do it. And once they do it, they can go on with the loan. So that's really important. Somebody else is actually going through the numbers to make sure that there's nothing unscrupulous going on.
Well, I'm sorry. I'm just taking notes down because we'll be doing this with my wife and my mother-in-law real soon. Tell me about appraisal needs, timing, start to finish. How long does this take?
I'd say start to finish is probably typical, almost like a regular loan. I would say anywhere from 30 to 45 days. Appraisal's basically the same. I mean, the same appraisal that we would as a residential loan. Might take a little bit longer because a couple of reasons. Number one, sometimes with the elderly, it's not as simple as them to go with DocuSign. You have to deliver certain documents to their home and, pick up things. And so they tend to take a little bit longer, and you want to really explain it to them so they understand what's going on. So, that part. So usually I would say between 30 and 45 days is typical.
I want to take a couple minutes as we're kind of getting close to wrapping it up here. I want to talk a little bit about why you founded American Home Finance and talk about the lending market a little bit. Lenders are out there. They really want to do business, so they're taking the phone calls, aren't they?
They are. They're very, very aggressive right now. And then with the rates went up pretty quick. So a lot of people took that as, business is very difficult and so on and so forth. But it's like anything else, the business must go on. People will buy houses. People will refinance. They need money. Things are always going to happen. So what they're doing is, from an aggressive standpoint, they're trying to figure out different programs, different ways to go. So everything is about the consumer, to make sure that the consumer pays as least as possible, and we can get them whatever they need to have. So yeah, they're definitely aggressive out there. They want some business.
And how long have you and your brothers been in the mortgage business, and what's kind of your business philosophy about dealing with people?
We've been in the mortgage business, at least myself. I'm a little longer than the two of them, but I've been in it over 25 years. And I started out as a broker working for a company, and it was a very good company. And the one thing that I took out of that, especially in the beginning, was that, you're there for the customer. You're not there to try to, make as much money as you can or any of that nonsense. You're there to help this person. You're licensed to do so. So everything I do is recorded. I'm licensed to do what I do. My NMLS number follows all my loans for 30 years. They'll always know who originated that loan. That's myself. And I take pride in the fact that I'll sit with people and really talk to them and understand their financial situation with the family, the kids, whatever it might be. I spend a little extra time doing that. And it's really paid off for me in a lot of ways in our company, because we get a lot of referrals from a lot of the families and friends of the people that we do business for. That's always been the case. And the other part of it is, anybody that I bring in as a loan officer, the philosophy that we're talking about is exactly what I'm looking for. Jim is one of them. Just people that care about people, and they want to take care of them and do the right thing. And that's really what it comes down to. That's why I enjoy my business so much.
Well, the mortgage crisis got rid of a bunch of shysters that were in it for a fast buck. Now they have educational requirements. I have the NMLS license too. And I look at it as being a financial advisor. I was at a conference yesterday, Friday. One of our clients, the office broker, you'll know who I'm talking about, came up to me and patted me on the back and said, "There's the best broker in Miami." I said, "That's just because you got that 2% interest rate stapled up on your front door, like we talked about. And we've helped a lot of people like that too. And now as interest rates are going up, we still have the same philosophy. Ed, we're wrapping up now. What would you like to say to the audience before we wrap up?
What I like to say is I think that when it comes to the residential mortgage business, it's for some people, this is a very difficult and scary situation. So, right now, the good thing is that a lot of people can go online and they can, research beforehand and just like figure out what's going on before they start. But more importantly, work with people that you're comfortable with, that have good reputations, that are going to really do the right thing by you. Because once we do the first loan or 2 loans, you are at least put in a position where you're not going to get hurt in the future. So I wouldn't worry about, the rates are higher or lower. It's not even about that. It's really structuring something that makes sense for your family, for yourself and your family. And that's what we do. And that's what we enjoy doing the most.
Well, Ed, I want to thank you so much for taking time out to be with us today. I want to say hey to the brothers back at the office. Thank you for them backing me up and working with me, making it easy for me to do my personal brand, which is helping folks and giving them peace of mind. I want to remind everybody that we're sponsored for well over a decade now by Warren Henry Automotive, that just like Ed and myself, they're all family oriented and looking to do the best by you and making sure that you get peace of mind when you do business with them. And I want to thank Ed Cairo, the founder of American Home Finance, for being with us on our periodic residential mortgage show. Thank you so much, Ed, for helping a lot of my friends and customers get peace of mind. I want to thank you for that.
You're welcome, Jim. Thank you very much, too. I appreciate it.
It's my absolute pleasure, Ed. Remember, this is Freedom Business. We're on all the time. You can get us. You can download us. We're on all the different podcast services. And we always put out a new podcast, noon on Wednesdays, live. And remember, the person who wants to do something finds a way. Oh, I want to thank our friends. Oh, I forgot this part. I want to thank our friends at the Bergstrom Center for Real Estate Studies. I'll be up at the Bergstrom Center conference coming up. Registration is closed. So if you're not registered, see you in the hallway. And remember, the person who wants to do something finds a way. The other finds an excuse. Now go out there and make it happen. God bless you. And God bless the United States of America. Mr. Mendoza, the rest of the show is yours.